We're here in Monte Carlo for the Rendezvous de Septembre. For Invest TV, I'm Richard Banks. And I'm joined now by Jim Bichard, who's Global Insurance Leader for PwC. Jim, welcome. Good to have you back with us.
Thanks for having me again.
So this year, as always, you've brought some interesting new research to Monte Carlo this year on the legacy market. Tell us some of the top level findings.
Yeah, the big finding was about, or the big observation was about the deal flow over the last year or two. Been quite a lot of observation about the fact that there's been fewer deals probably in the last year than we'd seen in the previous period. A lot of speculation about, well, is that meaning that legacy has run its course? Is it less relevant? But actually, there were probably some quite specific factors around some of the players in the market and maybe appetite from those who would be wanting to do those transactions. But if we look at the last 2 or 3 months, one of the big findings for us is that actually deal flows right back up to where it had been at its sort of busiest point. So we're seeing that as really just a little bit of a pause as opposed to a bigger trend. And then looking forward, we're expecting there to be probably a smaller number of deals, but each of them a lot bigger. So the total amount of liabilities, I guess, being covered is really pretty significant and continuing to grow. And so I guess that means the relevance of legacy as a tool is definitely growing. And the last thing I'd say on that is we had quite a few clients comment on that in our event today. The purpose, I guess, of legacy continues to move from it fixing a problem to being just a really sophisticated capital management tool for our clients to think about how they redeploy capital to other opportunities rather than having it tied up on the balance sheet. And I think that's a really good, positive way to think about the role legacy plays in the broader market.
So legacy as part of a company's sort of ongoing planning process.
Absolutely. It's about dynamic capital management, portfolio optimization, not about fixing a problem. That might be part of it, but that's not the only role of legacy. And I think increasingly the way it becomes a structured solution is really positive.
So obviously legacy business relies on sympathetic investors. Tell us about investor sentiment towards that part of the market.
Yeah, I think as I said, it's probably quite positive. There was probably a little bit of hesitation in the last year or so because perhaps there were some problems that needed to be tidied up and fixed. But I still think generally, I mean, one of the big, I guess, markers of that has been quite big investment in the sector in the last few months with a big transaction with one of the major players. Signals a lot of optimism or a lot of positivity about, the returns that you can get in that sector. I think generally speaking, there's probably more capital that is looking to come into that part of the insurance market. So overall, pretty positive. I still think it needs to consistently demonstrate returns, and each company participating needs to demonstrate returns. But on the whole, that's still been a good story.
Shifting to the live market for a second, but staying on investors. At this point of a hard market cycle, one might typically expect to see new startups. We haven't seen that. Why do you think that is?
Yeah, I think probably a couple of things on that. Firstly, it's important to look at where capital has come in. So there's been a lot of investment, a lot of capital coming into the market because of the positive results the last year or two. But as you say, just not in new startup balance sheets. So if you look at the ILS capital numbers, for example, I think we're at a record high, well over 100 billion. So that is that, investment and capital is still coming in. It's just coming in via those structures versus a new rated balance sheet. And also capital coming in via other structures that where either reinsurers, brokers or carriers are bringing third-party capital in, if you like, to try and match the risk. So I think we're seeing it come in just in a different format. And that still signals the same point, I guess, about the positivity, the returns that can be generated in the market as we see it at the moment. So as to why there haven't been more balance sheets formed specifically, I think probably because there's an easier or a smoother way for that capital to be matched against risk without needing to go through the process of setting up a new company.
Even without the new startups, the market is well capitalized. But in the event of a capital depleting loss, what are the investor sentiment likely to be there? Are they going to be confident about coming back in?
I think you'd have to say the last couple of years have been very positive on return on equity exceeding cost of capital, so there'd be a good story to tell. I guess it would depend a bit on what the the event was, if it was seen as something that then led to a really favourable pricing environment, particularly in a sector or a geography, then you'd like to think the combination of the prospect of future, price adequacy or positive pricing, plus the track record that's been shown for the last couple of years, those things would combine to being a good story for investors. But I think we have to remind ourselves that, as you do, that over the last 5 or 6 years, it's still quite recent. Our track record medium term has not been very positive as a sector. We still need to build up more years of that track record. So I still think you could attract investors, but you'd have to tell the story quite cleverly about why the more recent experience is indicative of what you can expect going forward.
So moving on from investor appetite to underwriting appetite, and we've seen from reinsurers a shift in their appetite and perhaps a move away from that sort of earnings protection that they were providing in the past to more capital protection. Does that mean that they're providing the solutions that underwriters or insurance companies are after?
I think for the moment that's what's happening, partly because reinsurers have had probably rightly so, a bit more say in how they're setting limits and where they're participating in different layers. Is that what carriers need? Probably not long term. I think what that's building up is a situation where reinsurers are choosing where they participate for good reason. Carriers are kind of living with that and are having to maybe absorb more volatility. But the knock-on impact of that is maybe this uninsurability issue is probably getting worse, not better. And I think that's a societal issue. That's probably a government issue as well, but where we've ultimately, the purpose of insurance and reinsurance is to protect those who need it, when they have an issue, and to create more resilient individuals, communities, or corporates. And so if we're not doing that as a combined industry, we're not as relevant, and we don't have a sustainable model. So I think for the time being there's an equilibrium, but it feels like that equilibrium needs to shift. I mentioned governments, I think, need to be part of that shift, because there's as I said, there's more something about the hazard and insurability issue. But I think we're going to see that move over time. And that's something that we talk about a lot in PwC, is the kind of longer term prospects for the industry, and does the business model need to continue to evolve and be reinvented using technology, using what data is available, etc. So maybe that's a way of changing that balance a little bit over time.
Monte Carlo, a great place for those conversations to start.
Exactly right, because this is where the trading happens, but also a lot of the innovation happens, and you've got all the right parts of all the right pieces of the jigsaw to put together. So very positive atmosphere. I just think we've got to keep thinking about innovating and longer term, not just renewals.
Jim, as ever, great to talk to you. Thanks very much indeed for your time.
Thanks for having me. Good to be here.
For Invest TV, I'm Richard Banks.